Good morning, ladies and gentlemen, and welcome to the show on this 24th, Wednesday, the 24th of February, 2021. Glad to have you guys here. Anyway, listen. All of these fiat currencies, ever since 1971, when they took them off the gold standard. See, they took the dollar off the gold standard. Nixon did. He said it was a temporary thing. It's not temporary, you know. And all of the fiat currencies were pegged to the dollar. All of them are. It's the world reserve currency. When the dollar was taken off the gold standard, the dollar became worth really, its intrinsic value is zero. And because all these other fiat currencies are pegged to the dollar, their intrinsic value is zero as well. It's all a confidence game, guys. The dollar is going to work well and good as long as people have confidence in it. Now, you know, there's still a lot of people out there who have a certain philosophy about the dollar. They believe that there's going to be a massive crash in the markets. 80% the market's going to go down. And the Fed is going to raise, the rates are going to go up, especially on the long end of the yield curve, you know. And the interest rates are going to go up and everything. And there's going to be a crash in the system, and there's going to be a lack of liquidity, lack of dollars, and that the dollar's value is going to go up in purchasing power, and we're going to have deflation through the system and everything. And, you know, there's a lot of people too, just common, ordinary people out there are scared right now. They see all these people jobless in America, and they see the economy weakening, and they say to themselves, hey, you know, I better hold dollars. So they save their dollars. You know, they pay down their debt. And so this gives, actually, in a way, this is giving confidence to the dollar. This is putting confidence in the dollar. And, you know, I've been saying this all along from the very start. What they're really missing is the fact that they can print these dollars to infinity. And they don't even have to print them anymore. All they do is push a button on a computer, enter in how many digits and how many units of currency they want to create, and push the button, and it's there. So why do all these people have such confidence and believe that there's going to be a super big deflation when the Fed has this? They got this. Basically, they're saying, but what don't they have? What they don't have is if everything starts to turn around and go in the opposite direction into inflation. Now, the Fed's already told you. They've said, hey, we've got an inflation target. Well, what does that mean? That means that the Fed is telling you directly that they're going to keep going. They're going to keep printing until they get the inflation target that they're looking for. But, you know, as far as confidence is concerned, what's really supporting the dollar and been supporting it all along is confidence. And once people start to realize that, hey, you know, all these people that have been praying for deflation and hoarding their dollars and saying, I'm going to be rich because I'm all in dollars, when they see that it's not going to be that way, that the Fed is not going to stop and the Fed's not going to raise rates or anything like that, when they see which way this is really going to go, they're going to start to try to get into hard money. Watch it happen. Anyway, guys, let's get started and let's take a look at what's going on. Let's start the charts right here. The first thing we're going to take a look at is the money velocity, the M2 money velocity. And this is a chart that the deflationists, people that believe that it's going to deflate, the system's going to deflate, we're going to have this big market crash, they point to this a lot. They say, hey, look, the velocity of money has fell off a cliff, and this is a sign of deflation, and down we go. And yes, they're right. You know, let's hone in on this a little bit closer. Take a look at it. You know, it's fell down, down. What do we see here? If we start to get toward the end, we start to move toward the end, get closer and closer to where we are now in the chart. I'm creeping in. Okay, what we seen was, yes, the velocity of money was falling, but it went down to hit, it's made a bottom. And this is what I'm seeing when I look at this chart. I'm seeing that Quarter 2, 2020, the velocity that was falling down on Quarter 2, 2020 made a bottom. And in fact, the velocity even came up a little bit by Quarter 3 of 2020. And now it's basically going along sideways on Quarter 4 of 2020. Okay, so the velocity is in hold mode right now. It's going along sideways, the velocity of money. It's waiting for an answer to a question. And this question has everything to do with confidence. Now, let's take a look here at the Fed and some of the things that the Fed is saying, and they're telegraphing to us. And we got to listen to what the Fed says. Powell also said, I'm going to underline it so you guys can see. It says, Powell also said in a recent run-up to bond yields that has unsettled the stock market. And in a statement of confidence, in a robust economic outlook, he added that any Fed action would be telegraphed well in advance, which means just one thing: no tightening in the foreseeable future, despite the market's recent freakout. No tightening. They're not going to tighten rates. In fact, the Fed has got their finger on the bond market. And I've been saying this to you guys. They're not going to let these yields rise. And in fact, they're probably going to keep them suppressed way off into the foreseeable future. It says, Powell's comments reinforced our view that the increase in inflation expectations is most likely transitory and that higher Treasury yields primarily reflect optimism over the economic recovery and reflation trade. Well, what does that mean? The reflation trade, and optimism over an economic recovery. Well, we got this virus moving out. I heard talk today that probably by this June, that there's going to be the computer models are showing substantial decreases in the amount of people that are infected with this thing. And the economy can you'd be surprised how quick new shoots can come up, grass can come up. Once the effect that's been pushing things down. Once people's ideas or concepts and their confidence starts to be lost that there is going to be a deflation. Once that actually happens, it can happen very quickly. And it's already actually the beginnings of it are starting to happen. That's why you're seeing so many people moving into silver and stuff. Moving into alternative assets like Bitcoin. Look at the rise of Bitcoin. Oh, and for you guys out there about Bitcoin, I'm just going to say one thing. A lot of you guys are waiting for a big crash in Bitcoin. Say Bitcoin's in a bubble? Oh, well, Bitcoin's not in a bubble anymore. We've had our big crash. Not in a bubble anymore. Sorry, guys. This might be all you're going to get. If you're waiting for the big crash in Bitcoin, you might not get any more. I mean, this might be it. Anyway. Let's take a look at these prices on things today. Let's take a look at the gold price today. The velocity of money that I was showing you guys, it's just waiting to go up now at this point. And it's going to go up. And it's going to get out of control. The Fed's going to lose control of inflation. They got this 2% inflation target. Once confidence is lost, once people actually all out there start to see, hey, it's not going to be deflation, it's going to be inflation. I better get my money out there that I've been hoarding, and they've been hoarding for a while now. Some people take their stimmy check and they put it right in the bank. Once they see which way this is really going, then it's going to be a stampede. That's what it's going to be. At a certain point, it's going to be a stampede. When the velocity of money starts to go up, it's going to be a stampede out of the dollar. That's why I'm expecting in 2022 this to strike. I think we're going to have a good year the rest of this year. I think things are only going to get better heading toward the end of this year. We're going to have a great Christmas this year. The rest of this year is going to be great. It's next year we got to watch out. That's when the real inflation monster starts to come alive. And not in the first part of 2022. I think the first 6 months of 2022 are going to be great. I think it's the second half of 2022. I'm telling you guys right up front. Second half of 2022, watch out. And 2023 is going to be horrible. That's the year these shows I've been doing recently. Probably that's what it's going to look like in 2023. That's when we're going to be in an inflationary depression. It's going to be like, what could I call it? Stagflation, a stagnant economy out there. Because when the real big inflation hits, it's going to stagnate the economy. And at the same time, prices soaring on everything. Faster than you can keep up, especially food prices in 2023. I think by the end of 2023 that it's going to be so bad that they're going to have to do their Bretton Woods sort of a reset. They're going to have to have a reset toward the end of 2023. And that's when we're going to see the whole thing go back to precious metals or some sort of cryptocurrency that maybe the cryptocurrency will even be connected to precious metals. But I think precious metals are going to play a huge role in what happens toward the end of 2023. So that's basically your timeline, what I think is the timeline is going to be. So I think the rest of this year is going to be a pretty good year. But when you're going into a crack up boom or a hyperinflation, that's what happens. The lead-in period's good. Study the German hyperinflation, and you'll come to understand this. The lead-in period's good. The economy actually starts to pick up because money's moving again. See, if you go back to this chart and look at the velocity of money over the long term for years now, look at this. Slowly descending down, down, down. 2002 down, 2004 down, 2006 down, 2008, 10. So we've been struggling through this. And see this gray area right in here? That was the 2008 recession. And look, it really slid down. It's been sliding down ever since, this velocity of money, down to a low point right here. Well, if this was a chart of some commodity, like if this was gold or whatever, and you looked at this, what would you think? You'd say, well, we're at a bottom. We've made a bottom. That's exactly what's happened. And what happens after you make a bottom on any commodity, like gold or silver or anything like that? You go down, 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 down until you finally hit rock bottom and you make a bottom. And it goes back up. That's exactly what's going to happen here on this chart. So velocity of money starts to go up. So does inflation. Big time. Big time, guys. Let's get back in there with the gold price today. $17.93 today, down $13. Silver, $27.72. It's up 7 cents. So we're seeing that movement I was telling you guys about a while ago, where the gold to silver ratio is going to normalize. We're seeing it happen in real time right here. With silver and gold prices, the silver price starting to normalize against the gold price. So you're seeing movements up in silver while you're seeing movements down in gold. Now, this is going to be, this is going to keep going. And, until we get down to a more normal ratio, maybe 35 to 1 or 40 to 1, But, when this whole thing happens, we go into this hyperinflation, the sky's the limit for the price of gold and silver, and when compared against the US dollar. So this is going to retain your purchasing power. And it doesn't matter what you pay for it. If you got in back when it was $14 an ounce, well, good for you. But if you get in now when it's $27 an ounce, that's not going to matter so much when the real inflation starts to hit. That won't matter to you so much anymore. The only thing that's going to matter to you is the fact that you got some. And the price is skyrocketing on it. And it's preserving your purchasing power. It's doing its job. It means that even though prices are skyrocketing, your wages are not keeping up, it means that your silver is going to still allow you to keep your lights turned on in your home. It's going to allow you to go to the grocery store and still be able to buy a cart full of food. Where a lot of people, their salaries just ain't going to cut it because food prices are going to... I'll tell you how food prices are going to skyrocket, guys. They're going to skyrocket like the prices of electricity skyrocketed in Texas. But the price of silver is going to be skyrocketing just as fast, or maybe even faster. So it's going to allow you to still be able to be in there and get something without having to make hard choices. Like what I mean by hard choices is your salary is only enough to pay for your food. So now how are you going to pay for your electricity? How are you going to pay for your rent? That's hard choices. And that's what's coming in 2023. But enjoy your time here in 2021. Enjoy your time. Enjoy your life here in 2021. Prepare yourself for 2022 and 2023, especially 2023. Because I think the rest of this year, things are going to only improve from now until Christmas. And I think the first part of 2022 is going to be good too. It's the second half of 2022. That's when we're going to really see the inflation starting to bite. And I think 2023 is going to be a total disaster. It's going to be those 2 years, 2022 and 2023, where you're going to see this explosion in the price of these asset classes, cryptocurrencies, gold, and silver. And when I say exploding price, I'm talking about them keeping up and actually moving ahead of the price of inflation. And you're going to see prices increase. In 2023, we could be going through a actual hyperinflation where food prices are doubling every couple days. Can you imagine that? You go into the store and a can of beans is $40 US. Yeah, the can of beans you pay $1 for now. $40 US. You go in there the next week, they're $80 US. That's what we're looking at. We're looking at Venezuela. And that's when you're going to really need your gold, your silver, your crypto to make ends meet. To keep the wolf away from the door. And I got to tell you guys this. Because the reason why is because if you don't do it now, if you're not already in there or not getting ready to get in there and get yourself a little bit in your hand, get it in your hand, hold it in your hand, wrap your little fingers around it. See that shiny metal in your hand. See that white looking metal in your hand and think to yourself, this is going to save me not right now, it's going to save me a couple years from now. It's going to save my butt. That's the way you got to think right now. The silver's going to save me. Cryptocurrency today, 1,500 billion. Right on the money. And, we were up to 1,700 billion. So we're down 49,572 for Bitcoins. Dow Jones today, she's up 162 points at 31,700. And see, this crash is not materializing. And I told you guys days ago, you're expecting the crash, the big crash. We went through the period. You remember? Going back a month or two on my show here, I was saying a crash is possible. A crash is possible. We could lose 25% of the market. We were going through the danger zone right then. That was the danger zone, Now, things are changing. We can actually see the light at the end of the tunnel. Way back last year, I told you guys around, I don't know, maybe December or November, I told you guys the dark period was coming. And I told you guys how long it would last. It would last January, February, and March. Well, we're not through it till the end of March. So there is still a possibility of this market turning over and falling. Until March. But I can see the light at the end of the tunnel now, guys. And those green shoots are coming. And by summer, you're going to see a rebound in the economy. But it's not going to be a super rebound. I mean, we're not going to go back to 2019 kind of economy immediately. That's not the way it's going to work. It's going to be a very slow rebound in everything the rest of this year. And as the velocity of money starts to increase later in the year, maybe probably this September or something, we're going to see the velocity of money go up. We're going to see prices starting to, that's the lead-in period to the hyperinflation, called the acceleration phase. And generally it's when the economy starts to rebound. It's that rebound that causes the hyperinflation. See, you do not get a hyperinflation from a deflated economy. It's when the economy starts to reflate, or an economy that's overheating. That's what gives you the hyperinflation. And the Fed, with their 2% or above target for inflation, that inflation is going to run away on them once they start to actually get it. You ever heard the old saying, be careful what you wish for? The Fed's wishing for inflation. And by gosh, they're going to get it in spades. Okay, crude oil today, 63.22. Move index. So crude's going up. See, these things that are going up, like crude and Bitcoin and cryptos and all the other commodities, are starting to go up a little bit. They're front running. They can see this coming. This is coming. Inflation's coming, guys. Inflation. And for the general economy, it's going to, when it really hits hard, it's going to yield a stagflation. Well, it looks like the move index has peaked at 61.73, and it's starting to ease back down a little bit again. Bonds and rates, so we got to keep our eye on these bond yields, and they're getting up kind of hot. You know, we've seen a pop in these bond yields. U.S. 10-year at 1.37 and U.S. 30-year at 2.22, and they're up about 2 basis points today. So bond yields are rising on the long end, and this is something that the Fed, you can bet that they are watching this like a hawk. The Fed right now, watching this like a hawk, to make sure that that these yields do not get out of control. But they must feel fairly confident where they are right now, or maybe a little bit higher. They're not overly concerned. But if these yields on the long end start to get too high and they bounce up too quickly, the Fed will come in and they'll slam them back down again. They'll do what's called yield curve control. And they're probably going to have to do that as the economy starts to heat up. They're going to have to buy all the bonds all the way out to the 30-year. They have to buy them themselves. And they can do that. It can start overnight. You know, yields maybe on the 10-year might get up around 2%, you know. And all of a sudden, you know, let's say cross that Rubicon past 2%, and the market starts to fall off and things start to happen within the markets, bam, the Fed will come in overnight and you'll see them yields drop 10 basis points the next day, all the way down to the 30-year. Boom, boom, boom. They'll just hit like that. They come out of nowhere. Dollar index today, 90.31. And it's rising today a little bit. 90.30 right now. Okay, guys, that's your show for today. Remember, like, subscribe, hit the notification bell, you know, and try to comment a lot. And all this really helps my channel, you know, and I think my channel is starting to grow again. Thank goodness, you know. It's up a little bit. So keep up the good work, guys, and thank you very much. I really appreciate that. Bye-bye.